Good morning, everyone. Welcome back to the Wilson Weekly with the amazing Dr. Andrew Wilson and, of course, me. Very, very nonchalant and unexciting compared to Doc and his data. But welcome back, everyone,
mate.
and good morning, Doc.
Yeah, good day, Graeme. And don't undersell yourself, mate. You're pretty amazing too, mate. Let me get that one straight.
It.
No, it is. Anyway, we'll stop the group. We'll stop the group hug. The group, the group hug, and what a week it's been. Did you have any money on the cup, Graeme, at all? Did you get involved with the big race?
No, apparently each year I only buy the leftover in the sweeps. You know, you do the newspaper sweeps or whatever, and someone comes and takes some money out of my wallet, and I get the leftovers. But I think they took $20 out of my wallet, and I got $7 back or something. So, I'm not much of a punter.
No. I've left that life behind me many years ago, Graeme, and I just happened to be flipping around on the box, and there it was. And it was just coincidental that I actually watched the race as it was just finishing up. So, but I wouldn't have had a clue about it. But it's a big day. But of course, the real big event, for us, was the Reserve Bank's Melbourne Cup decision, and I guess we're on the money if we can talk about that. If we had have had a bet, I think it was really short odds that they were going to raise rates, and we've been saying that for a while, Graeme. In fact, we
didn't just say it last week. We said it for quite some time, and I actually expected them to go a little bit harder. I think that was a little bit soft and a bit rubbish.
Yeah, it was. That's very interesting, Graeme, because the conversations I've had around the place are sort of follow that, particular proposition that maybe they went a little soft. That this is basically the last, decision that'll have an impact for the year. That's why we said they'd go in November, as they typically do if the tea leaves are pointing that way, because, really it's not much point doing anything in December, although they may now follow it up in December, realising that, maybe they've got to go a bit harder. So, maybe you heard that first, that there'll be a rise in December too, because really once December's passed, there's no opportunity. Traditionally they don't meet again till February, but of course the model has changed now. And we really don't get any substantial data out until, March, because it's really holiday data. So there's nothing much that can happen for a couple of months at least. So, given the fact that, they were, and this is a new term, they were having a snooze-a-thon through winter.
Snooze-a-thon?
Yeah, perhaps. Perhaps a snooze-a-thon. Because, the data just didn't change. Yeah, okay.
The RBA, the Reserve Bank of Australia snooze-a-thon. There you go. It's even hard to say.
Graeme. Hashtag snooze-a-thon. Now you got me.
Snooze-a-thon. I can't. Yeah.
So hashtag snooze-a-thon, right?
Yeah.
And it was, and we said that. We thought it was a real shock. I did. We both said it was a shock that they went into pause mode in May. Other jurisdictions, the US, Eurozone and the UK, were raising rates still then. Yet we decided to go into pause, and the data was unequivocally strong. You can only really go on the main data. And unfortunately, in terms of the outlook for monetary policy is about creating, fewer jobs and higher unemployment. That's the plan, really. And the labour market's just been booming almost beyond belief. Strongest ever you could make a case for labour market we've ever had. And the way you stop people spending at the end of the day is, unfortunately, by putting their jobs under pressure. And we just haven't seen any sign of that month after month after month. And the RBA has sort of been trying to talk up other sort of, a little bit more esoteric measures of labour market activity, like hours worked, medium term jobs, unemployment, all these sort of bits and pieces, which, there was a case to say maybe they were easing. But at the end of the day, it was almost as though they were looking for some sort of measure to justify their position. But at the end of the day,
I love, Doc? We've talked about this in the last few weeks. There's all the gurus out there that can't interpret the data talking about a recession based on GDP and blah, blah, blah.
Per capita,
now, per capita. So they've got everyone listening at home. It's very important how people providing you data choose to interpret the data or the type of data they're using. Now, Doc, if we're talking per capita and let 500,000 people into the country all of a sudden, would that not skew the data? There's more capita.
That's right. You know? And that's the point. We've had a record surge in migration because we're getting the inflow, but we haven't had the outflow, right? Particularly with students, because students are coming in, but normally we get a net result. But the net result is obviously skewed on the upside because students who normally would be leaving aren't leaving because they haven't been here for 3 years. You know what I'm saying?
Yep.
So it means that all these extra people obviously are detracting from the per capita measure because, that's and even our measure of per capita GDP is so far ahead of where it was pre-COVID. That sort of tells you the whole story. It's just we are still, creating a lot of economic activity. GDP is trending upwards, well ahead of where many predicted, of course. And a real recession is just, way out of the realms of possibility at this stage. So, it's sort of let's jump over the per capita thing and ignore the fact that we've had this huge surge in population, which, of course, dilutes the per capita model, right? Because we've got all this extra people all of a sudden are in our populace. So, again, look, at the end of the day, maybe you could say that policymakers are trying to, even though it's not clearly supported by the evidence, the data, are trying to scare people into not spending. Maybe that's their plan. Maybe I'm giving them a get out of jail card here to justify the errors they are making in their statements in terms of the data. But quite clearly, Graeme, absolutely no justification for a pause on the data. And they keep saying, we're going to wait and see because it has a lagged effect. Well, they got it wrong. So it's clearly they got it wrong, that they paused too soon. And it wasn't just that, okay, well, we reckon there's, it has a lagged effect, so we've got to wait a while. It might be happening, but we're not seeing it in the data yet. And we want to make sure that we don't go too hard because then it might, we might end in a significant economic downturn. Okay, well, they've taken that position and they've proven to be wrong, right? Because they've now come back 6 months later and said, okay, well, we've got to raise rates again. And they're very much now saying, well, it depends on the data coming through. And I thought what was interesting in the commentary was that the Reserve Bank said, we look at the data that's being published, of course, the ABS data, particularly on the labour market, and we take our position based on that. But they're saying, we've got this other data, right? Trust us, we've got this other data that we've seen. So we're doing it on that basis. And that's come through all of a sudden and told us that we've got to raise rates again. To me, that's a little disingenuous, to be quite honest, when all the other data has quite clearly shown that the economy is not slowing down, that interest rate increases have had no effect at all on reducing demand in the economy. Certainly not after 12 rises, starting from zero, heading up over 4%. We haven't seen any evidence of a weakening in the economy. In fact, the economy has actually strengthened over this period.
Doc,
we're going through a period.
What about this commentary, Doc, of upon the revised data? What about the Reserve Bank saying, actually, we've revised our data and forecast? Now, so let's talk about this for a second. What's this nonsense about revised data?
Well, what's concerning me, Graeme, is the last few meetings, the commentary out of the Reserve Bank has really focused on the housing market. And it's sort of like we're going back to the old regime, which I believe there was way too much focus on what was happening in the housing market as being a driver of monetary policy. rather than the other way around, monetary policy being a driver of the housing market, if you get what I mean. I'm not sure why we should be at all interested in what's happening in the housing market in terms of what we do with monetary policy. It's back to this crazy fantasy land bubble stuff, right? When we look at the real evidence in terms of Australia's housing market, we have a very robust and resilient cycle of prices. The worst we've ever done is 5% down over a year. And we've only gone down 4 years since 1987, right? So, and yet there's all this worry about, we've got to watch that house prices aren't rising. And again, the commentary recently from the Reserve Bank was saying, we're keeping an eye on house prices. They are rising again, forgetting the fact that, yes, house prices are going to record double-figure growth in most capital cities this year, Graeme. But when we put it in the context of...
Just repeat that, Doc.
Yeah, double-figure growth in most capital city markets this year, Graeme.
Oh, okay. So we're not losing 10 to 30% like the media have been saying.
Oh, no, we're going to gain 10 in most markets, Graeme. And in fact, Hobart's the only market that'll probably go south. And even then, Hobart's starting to pick up again. But the point is, we've got to understand that even with that 10% growth, which the Reserve Bank is looking at in isolation, saying, we've got to watch house prices, we've got to understand that over the past 2 years, we still haven't caught up. Sydney and Melbourne still haven't caught up with what they lost last year. So even though we've increased in Sydney and Melbourne, Melbourne's still 3% below its previous peak, and Sydney's about 1% below its previous peak. Sydney lost 9% last year, Graeme.
So these people that are trying
Melbourne lost 7%.
We know there's no such thing as timing the market, Doc. It's the time spent in the market that receives a return. But these people that are timing the market, what I'm hearing is that there's still a slight discount in Melbourne compared to maybe 2 years ago, or Sydney maybe 1%, but it's 1% in Sydney, say. But very quickly, by another month or two, you could forget it, and we could be back past that peak, and you're now paying more than you did a year or two ago.
Yeah, so you're losing the discount, Graeme, and that's why we're going to see prices growth easing, because the affordability issues are starting to sideline buyers. And that's just the way the cycle works. We've caught up with what we lost last year, so we don't have the discount anymore. We've got higher rates. We've got higher inflation. So that tends to slow the market down. And here we have gobbledygook coming out of the Reserve Bank like, we've got to watch house prices. Like they're going to start thinking about, manipulating official rates based on the housing market. This is what we saw the previous jurisdiction of the Reserve Bank do through 2016, 17 and 18, when they held interest rates on hold for a record period of time because they were worried about some overinflated housing market. And what they did, Graeme, quite clearly was they didn't give the economy the stimulus that it really needed through that period, because we were really struggling. Unemployment was over 5%. Our GDP growth was low. And yet the Reserve Bank didn't act by lowering interest rates because I believe there was this, obsession with inflating the housing market in terms of this fantasy land bubble theory, which is complete, BS in terms of reality. And the Reserve Bank had to reverse gear really quickly in 2019 by slashing rates because they realised that they'd got it wrong, that they held rates way too high for too long because of, I believe, an obsession with this bubble theory of, asset overreach. And, we paid the price with our economy, and once again, I'm fearful that we're talking the same talk that we did in those days in terms of, we've got to watch out for house price growth. But this time it's really crazy because house price growth is just catching up with what it's lost over the last year in Sydney and Melbourne. So there's no runaway housing market here that's got to be controlled. We have, as I said before, a remarkably robust and resilient housing market. Reserve Bank, I don't know, head in the sand. Who can understand that they just don't look at the hard evidence in terms of the cycle and understand that because of our very strict lending criteria in this country, we are restricted from, that overreach, from over borrowing, because banks have market power and they won't take risks, which means we don't take risks, which means we don't overinflate the market. So and we just get the normal up and down cycle, which has been exacerbated through COVID and interest and higher inflation, and then higher interest rates are obviously impacting the market. And now we're sort of reaching back to ground zero because we're back to where we were, 18 months ago, Graeme. So let's just hope that common sense prevails, and I think that we've got more interest rate rises coming. I think you're right that we should have there's a clear argument that the Reserve Bank should have gone up 0.5% on Cup Day, and maybe that'll mean that they may go up. You heard it here first. Maybe they'll go up in December. Maybe they'll have a follow-up increase in December. Particularly, they won't know by then. But the US are now talking about another rate increase this year.
Well, Doc, if they don't go up, if we don't go up another 0.25% in December, Doc, it has to be 0.5% after Q1 next year. I mean, we're not going to see inflation settle down. I mean, seasonally adjusted, but we're not seeing inflation settle down in the month of November, December, Christmas, holiday time, seasonally spending time, travel time, family time.
Yes.
So, realistically, the demand for goods and services is going to skyrocket in this period over this next 2 to 3 months. So, really, if they don't go up a quarter at Christmas, they're going to have to go up. I'm going to say it. They're going to have to go up a half in sort of March, April. They'll have to.
Yeah, that's right. And the point is, Graeme, that November is now the big spend-a-thon in the year. November's the month where we see the highest level of retail sales now because we have Black Friday sales. A lot of the December Christmas spending is now done in November. December, of course, used to be the big month for retail spending, but now that's shifted back to November because of those Black Friday sales. That's another reason why the Reserve Bank had to act in November, because it wants to try to slow down some of that spending, and that makes a lot of sense. But they're going to get that data coming out and followed up in December. So maybe that's another case for an interest rate increase going forward. But the real issue when we talk about in a relative sense is that our interest rates are still, despite the 0.25% rise this week, Graeme, are still 1% lower than the US. So we have one of the lowest official rates in, from advanced economies, right? Now, it doesn't mean we should be exactly the same as everybody, but to be 1% below. But the real killer here, the real kicker, is that our inflation rate is nearly double that of the US inflation rate, pushing up towards double the underlying inflation rate. So our interest rate is lower, but our inflation is higher. Does that make sense to you in a relative sense? So I think we just went too early, and now we're in catch up. And I think there's more catching up to do, Graeme. Have you seen the price of fuel lately? Fuel's at nearly $2.30 down in Melbourne.
Where are you? You're Melbourne today, Doc?
Yeah, I'm in Melbourne today, back to Sydney tomorrow. But the price of fuel is nearly $2.30, Graeme.
$2.30 now.
Discounted.
And we had the government step in during COVID when fuel was about $2, $2.10. But we're $2.30 now. Where are they now?
Well, and that the point to that is that has such a flow-on effect for other price increases because everybody's relying on transport, petrol, etc. Now, there's some better news over the last few days on the price of oil. It's actually fallen below $80 US a barrel. But, we don't know how long that will be sustained, down, because it's been up and down like a yo-yo over the last month or so, Graeme. But that's the killer in a sense, is if the price of oil starts pushing up again, above $90 US a barrel, because that'll again, have more upward pressure on inflation. But the relief we've had from inflation, which, the Reserve Bank and other banks are pointing to, central banks are pointing to, we brought inflation down. It's because of the adjustment that was going to happen anyway from too much demand and not enough supply through the COVID stimulus period.
Correct. It was the dam. Yep.
Like we threw all the money at the economies, which is exactly the right thing to do because we're in times of extreme uncertainty. But it created so much demand, we didn't have the supply to match it, so prices rose. So supply is now catching up with all that demand. Goods supply is catching up with all that demand, and the demand's been, extinguished to some degree, satisfied to some degree. But the problem is now we're getting that inflation, sort of stimulus working its way through other sectors like, the service sector. And that's why you look at so many consumer goods at the moment are on the increase. Cup of coffee, everything is significantly higher than what it was. And the point is that, consumers are going to say, look, I'm paying all this extra, I need a pay rise, and that becomes then going to the employer asking for a pay rise. And the employer saying, well, I'm not really making that much extra money, but I'll give it to you anyway because I can't find a worker and I need you. So the only way the employer can cover those extra wage costs is to put their prices up. And that means that again, you see consumers saying, oh, you put your prices up, I want a wage rise, and on we go. Now, this is the great fear for central banks, is that wage prices spiral. Now, next week, Graeme, we are going to get the September quarter wage index data from the ABS. It was a bit of a shock, the last June quarter data, Graeme, and we sort of discussed this because annual wages growth actually fell, which was, what? Are you kidding? With this booming labour market, we actually saw the annual rate of inflation fall of wages growth fall from 3.7% to 3.6%, which is a little illogical given how strong the labour market is. So, we've got to be, as we've discussed, there's a lot of questions about the ABS data, particularly their seasonal adjustment, because that's sort of been put, under question because of COVID, and that's fair enough. But it may be that we'll get a bounce back in wages increase with that September data. I mean, after what happened in June, I'm not saying anything, but I would suggest that we really, with this economy, should be getting closer to a 4% per annum wage growth outcome. Yeah. So we'll see when this data comes out that it might be a compensation for what was a bit of a shock result for the June quarter. And if we do start seeing wages breakout in a sense, that will again put a fire under the Reserve Bank, because that's the last thing they want to see is wages increasing, close to the inflation rate or above the inflation rate, the official interest rate, because, that's only going to fuel, inflation, wage demands, which will fuel higher prices as employers have to cover those wage demands, which will mean, higher interest rates. So it'll be very important, that data next week, Graeme, for us to look at, because I've just got a feeling that'll be a bounce upwards. We don't know. As I said, this ABS data has been very volatile and certainly hasn't followed the patterns what you would expect them to do, given the position of other correlating economic data. So look, it's I think we've got more interest rate rises to come. I think we may even get a December rise. And particularly given we're going to have a very strong spending month this month with Black Friday sales, November spend-a-thon, and then, of course, we've still got Christmas sales to come up. So don't be surprised if that 0.5%, which maybe we should have had in November, is going to become a 0.5% combined November-December.
I agree, Doc. I agree. Well, let's jump in, Doc, and have a look at the data before you and I end up. We'll end up chatting all day. We love this stuff.
Well, look, I think it's very important for those that are watching, Graeme, because you have to have reliable information and insights, and we're not just sort of throwing a dart at a dartboard here or coming up with an exciting headline that'll give you some media space. Everything we say is based on evidence and experience. And that's the point. I think that people have to make, particularly property decisions, based on, what's actually going to happen. And that's the point, that we try to emphasize here, is that all we say is evidence-based, and we have our own data that we present as well. So, and that was the point you made, and we sort of got off track a bit about the revised data, and that the RBA is talking about using house price data that's been revised. I don't know where they're getting that. I don't know why they would be using data that that becomes revised, and therefore their position becomes revised. Don't you want to have reliable data that isn't revised? So you're at least on the money with your say, oh, well, we've changed our mind because the data that we're using has been revised. Okay. I think maybe you've got to think about the data you're using, wouldn't you?
I think if you're making the policies and the decision and policymakers for the economic situation of an entire nation, I don't think you should be revising your data. I think your data should be pretty concrete. But anyway, enough RBA bagging, and they've had their snooze-a-thon. I can't even say it. It's so dreary and nappy. They've had their nap, they've had their snooze, and now, very sadly, Doc, you and I are calling it here early for all our viewers and listeners. Don't be surprised if what should have been 0.5% is through November, December, that we cop another 0.25%, 25 basis points in another 3-4 weeks' time. But over to you, Doc, for the data.
Yeah, and I think if we don't, Graeme, it's another snooze-a-thon. You know what I mean? Yeah. It's just back into the land of nod, in terms of that. So the RBA has conceded they need a rate rise. We've discussed this ad infinitum, that it was likely to happen given what we said was a too early pause back in May, followed up by those other pauses after June, 5 pauses in 6 months. So they concede rates are still too low, that rate rises did follow the rate rise did follow 5 pauses over the last 6 months. The economy is still clearly strong despite 12 rate rises since May last year. And why is it strong? Well, we've got the jobless rate falling again over September, Graeme, back to near record lows, 3.6%. Of course, the record low is 3.5. Jobs are surging. We had another big increase in jobs over September. The number of unemployed fell again. So, I mean, really, the participation rate bounced back to another near record high. So there's nothing here that's saying that the data is being manipulated by other factors such as, the unemployment numbers or the unemployed numbers or the participation rate. It's just a very, very, very strong economy that has shown no signs, Graeme, no real signs of slowing down. And the signs we need is a higher unemployment rate. And, the Reserve Bank has actually now brought its forecast down for where the unemployment rate will be next year. So they're now saying 4.25% unemployed, which is still a very, very low number, is where we're heading for. And I'm not sure that's the sort of number that's going to bring inflation down. And the point with inflation, Graeme, is you've got to understand we've had the adjustment through the normal adjustment, which maybe would have happened anyway if we hadn't have had those 12 rate increases. We still would have seen inflation coming down because of the post-COVID adjustment that we've spoken about. Going forward, we've now got more of a concerning position where inflation is becoming entrenched in our economy. Also, retail sales were up by 0.9%. The latest data, September data, Graeme, that's the biggest rise in seasonal adjusted retail sales since January. So, the ABS is trying to tell us that retail sales trend is at a record low. Well, yeah, because it's come from a record high. Come on, context, guys and girls, right? And it's way above, retail sales levels are way above those pre-COVID levels. In fact, they're, nearly 40% higher than pre-COVID levels, which even accounting for inflation and the migration surge shows how strong underlying retail sales growth remains, and it's still rising. And of course, we know, as we've discussed, that inflation is now rising 2 months in a row. Inflation increase, Graeme, annual inflation. And again, it's been driven by housing, particularly food and fuel. And housing's the big, the big concern here. There's really no relief in terms of the drive for rents are continuing we're going to look at the rent report in a minute for October. Rents are continuing to rise, and certainly we've run out of rental properties. And we've now plateaued in terms of house building costs, Graeme. We'll look at those next week. The house building costs are plateauing now at around about 10 to 11% per annum. So after a period where they were falling, house building costs, they're now steady and with some upward pressure at around about 10%. And that will only add to inflation and likely mean that house building costs, 10% per annum growth will become entrenched, that will become the norm for tradesmen, builders, etc., tradespeople and builders, etc., to put in their contracts. So the big picture is, and you have to say it, the RBA got it wrong again. They paused too soon, right?
Well, I think you can add to the end of that sentence, Doc. I think the RBA got it wrong again, paused too soon for too long.
Yeah, and this is just a repeat of previous jurisdictions, right? Now, whether they want to be everybody happy in the short term in terms of, interest rates or, over emphasis on the housing market, which was it previously. But whatever it is, it's a clear concession. And even though they say, well, we were just relying on the month-to-month data. Well, the month-to-month data just didn't change, Graeme, month after month after month, and that they continue to pause. And now they're saying, we've got some, insider data, which is, secret RBA data sort of thing that we're using to justify our rate rise. It's just really very concerning. And going forward, I think it only means more increases in the gun, particularly given our position compared to other jurisdictions. So there's the cycle there, Graeme. You can see the pause in the trend back up to 4.35%. But look, Graeme, we're still below where we were back in 2011-12.
And right? I think this is the point, Doc. Everyone's freaking out. We're still below where we were coming out of the GFC.
That's right. So, which was mining boom number 2. A very strong period of growth there. The Reserve Bank was pushing up rates. Of course, it's a different context because we started from zero. But that's the other point, Graeme. We started from zero, So we started from the lowest base ever. And as I said, there's, an argument to say that we still would have got our inflation result today without having touched, interest rates. But of course, our dollar would have gone through the floor because our interest rates would have been so much lower than the rest of the world. But nonetheless, we can see we've sort of ended the recent growth cycle. Now we're into another growth cycle. And don't be surprised if we get a December increase if the Reserve Bank, realises that they're a little bit hamstrung in terms of taking action when they need to take action by catching up with what they missed out in terms of the opportunities to increase rates, which, in my opinion, they should have done consistently from May onwards. So they said the RBA in its commentary on the day said inflation has passed its peak. Still too high, though, and providing more persistent than expected a few months ago. So, again, they're conceding that it's more persistent than they expected. They concede that their forecast for a CPI inflation will continue to decline. That's saying two things in the one word, CPI and inflation. Anyway, progress looks to be slower than earlier expected. So, again, conceding their earlier predictions were wrong. Since its August meeting, they have received updated information. Oh, really? On inflation, labour market, economic activity, and the revised set of forecasts. So, and the outcome of all that is that this suggests that the risk of inflation will remain higher for longer.
Where do we
as that risk is increased?
Where do we subscribe to the updated information? Where does that come from?
Well, it's all there, Graeme. I mean, they're basically saying, yeah, okay, we got increased inflation over August and September. Well, we knew that, right? We saw that, and they're using that as their excuse. But the other end is that, okay, inflation has increased, but it was about inflation going backwards underlying inflation still at 5%, and that takes out the volatile items, which is way above where the target is, 2 to 3%, and also way above other advanced economies, particularly the US. Now, we knew that way before we got the August and September inflation data, but now they're saying, okay, and that's because fuel increased through that period, that the risk of inflation now remains higher, that the risk for inflation remaining higher for longer has increased. And, of course, they're using the disclaimer that there are significant uncertainties around the outlook. So they're basically saying, well, we don't know. And you would have thought that it would have been better, in a sense, given our relative position to overseas countries, to overseas advanced economies, that we would have followed their pattern in a way, rather than going out on a limb, which we did, and pausing when we did way back in May. And what they're saying is services price inflation has been surprisingly persistent overseas, and the same could occur in Australia. Well, it's already occurred. What do you mean could occur? You know, we're seeing those services costs rise. I mentioned what a cup of coffee is doing, and there's lots of other examples. So, you know, we've got to sort of now start to realise that this is a task ahead of us, that the last bit of inflation anyway is the toughest to match. And unfortunately, the real indicator for controlling inflation will be higher unemployment. And we just have seen no sign of that at all. In fact, unemployment is falling, and we will look at the wages data when it comes out next week, Graeme, because that'll be very interesting. Even though it is the September quarter, which means it's covering July, August, September, so it's a bit backward looking. But anyway, that's all we've got to go on. So we've done our economic palaver today. You know, we've kicked the Reserve Bank from pillar to post. So we'll get on to something a little bit less dramatic. Well, it's dramatic, but a little bit less, it's interesting, but I won't say what it's less, but it's still interesting. So rental markets are still tight, Graeme. This is the latest My Housing Market rent report for October. Another tough month for tenants. You know, there's really been no relief, a little bit of relief over August, but of course over September, but that followed a very tight August, which we typically have for the beginning of the second half of the university year. But so capital city home rental markets continue to produce tough results for tenants over October. Already low vacancy rates, generally falling, and asking rents, particularly for houses, are still rising, Graeme. Rental markets remain intractably tight in most capitals for both houses and units, with record low vacancy rates placing continual upward pressure on asking rents. And we certainly have the rising prospect and this was done, of course, before the rate rise, of a near-term increase in official rates will motivate landlords to increase rents to offset likely higher mortgage costs. So higher mortgage costs will mean higher rents, Graeme. So bad news for
pretty straightforward. Anyone who's got a lease ending shortly with another rate rise just occurring, the vendors, the owners, are going to put the rent up. They need to compensate the increased interest expense. So that means rents are going to increase yet again. It's already hurting.
And because it's such a tight market with so few properties available, landlords can do that. And there's not much choice that tenants have got because, there's just so few properties out there. But, of course, tenants are restricted in terms of just how much they can pay by their income's growth. You just can't keep, paying more unless you're getting, higher income. So it doesn't keep going month by month. It waits until those income factors can catch up, and then we start to see it rise again. And Sydney's a typical example of that. Sydney's median rent was steady at $750 a week, but it's still the best part of $200 above Melbourne. Melbourne eased a little bit, down by 0.9%. Brisbane's been very strong lately, Graeme. House rents in Brisbane up by 2.1%. That was another increase, monthly increase. Adelaide also up. Perth up, strongest of all the markets, up by 2.5%. Perth's median house rent is now over $600 a week, Graeme. Hobart picked up after a couple of recent falls, up by 1.9%. It is the most affordable capital city for house rents, Graeme, Hobart, at $545 a week. When we look at the annual results, still, bad news there. Melbourne, even though it had an easing of 0.9%, rents are still up by 16.3% over the past year, Graeme. Similar to Sydney, 15.4%. Brisbane up 11.4%. Adelaide up 12.5%. Perth up 13.9%. And really only Hobart's providing any relief in terms of, and Canberra in terms of annual growth, with Canberra down by 3.2%. But look at those crazy vacancy rates, Graeme. That's just madness. Only Hobart has and Canberra have vacancy rates anywhere near 1%. 1% in Hobart, 1.1% in Canberra. And look at the rest of them. That's basically, you almost got a zero vacancy rate in some of those markets. They're all well under 1%, which is, as I said, crazy stuff going forward. With unit rents, some better news there in terms of the monthly outcomes. Unit rents stable in Sydney, Melbourne, Adelaide and Perth, down a little bit in Hobart, which, as we've suggested, is a weaker rental market at the moment, or weaker in general housing market at the moment. But those rents are still high, $750 for a median rent in Sydney, which is the same as houses, $550 in Melbourne, which is $200 less than Sydney. But Brisbane, its unit rents up again, Graeme, so plenty of demand there for rentals in Brisbane. Its unit rent now is at $600 a week. Tough market there for Brisbane tenants. And when we look at, and up again, as I said, 1.7%, when we look at the annual results, still 30% higher in Sydney compared to a year ago, 23% higher in Melbourne and 20% annual increase in Brisbane for unit rents. Vacancy rates a little bit higher than house vacancy rates, but nonetheless still low. Melbourne 1.7%. Got to remember, Melbourne's come down from around 7% vacancy rate at the peak of the COVID issues, and so they're well below where they've been. And only Hobart really has got a reasonably balanced market, but it's a very small rental market for units, Hobart, Graeme. So again, no real, what you call significant relief there for tenants for units as well. So it's the same old, basically every week, every month that we bring these results out, there's really no sign of an improvement. It's just the best we can do is for a month or two, maybe keep rents steady before they start to rise again. And it's just basically we've run out of rental properties, and that's all she wrote, So let's look at home building approvals.
This flows into why it's so tough, Doc. I mean, approvals down again.
Yep, down again. So again, no relief for building approvals, down by 4.6% over September. And that followed the 7% August fall. Volatile units down 5.1%. Houses down 4.6%. Queensland bounced back with approvals up 34.6%. But there's no doubt that those annual growth levels remain chronically depressed. You can see the trend there continuing to fall, well below where it was a year ago. This is national home building approvals, seasonally adjusted, continuing to fall. So no new housing coming. And look at that, down, monthly, year to date and full year, houses, units and the total. So just no relief there at all in terms of trying to reverse the shortage of housing we have in this country with higher new building levels, just not happening. And, we're pushing forward to nearly a year since the federal government gave its aspirational target of all those extra houses, and we're not seeing any sign of that occurring. And at the end of the day, it's not the national government. They can sort of try to facilitate increased building from the private sector, but it's the private sector that's going to have to provide the building. And as we've discussed constantly, there are just too many roadblocks for new building, Graeme. Planning restrictions, red tape, green tape, and of course, as we've already discussed, and we'll look at in more depth next week, high house building costs, which are still quite high. And there's the big picture trend. Home building in the capitals is down 36.5%. This is the annual monthly trend. And you can see how much lower we are in terms of where we were at our peak in 2016. And it is all about units. The beige colour there is the unit trend, and units are down 52.3% since that 2016 trend. So, of course, this is a significant contributor to the fact that we have such a shortage of housing in this country, and what we see with that terrible rental market for tenants, And even now we're seeing the trend for house building, capital city house building, is now below that peak, that previous peak, having come through that very strong period from that home builder policy of the previous government. So the capital cities, only Brisbane has shown a reasonable result there, flat over the year to September versus the same last year, and Melbourne is still the strongest capital city for building. And Sydney now building more units than Melbourne. We saw earlier in the year where Melbourne had taken the lead in terms of units, and this is the year to date. So this year to date, so that's the 9 months to September versus the same period last year. So no good news there. I'm sorry, Graeme, for the rental market. I'm sorry for tenants that we're not seeing any reverse in the underbuilding in this country. But again, we're not alone here. We're seeing this in most other advanced economies, low building levels and very tight rental markets. So we had our first auction weekend for November, Graeme. So we're now coming into the back end of the spring selling season, and typically that means higher listing numbers and lower clearance rates. There's more motivation for sellers, but there's less motivation for buyers, particularly those buyers who haven't sold their properties yet. They start thinking, okay, we'll wait till next year to get into the market. So that's why we see typically higher clearance rates and certainly higher listings at this time of the year. So last weekend, it was actually quite steady following the previous weekend's Super Saturday. And, of course, it was a distracted weekend. We had the Melbourne Cup long weekend in Melbourne and also some distractions through the Cup through most of the other capital cities as well. It'll be interesting to see what, and we've said here about the Melbourne Cup Day rate rise, what that impact will have this coming weekend on the auction market. So that'll be an interesting result. So here are the numbers. Another big weekend for auctions in Sydney, Graeme, despite the sort of holiday atmosphere there. Of course, Melbourne Cup's not as much as a big deal in Sydney, although it's a pretty big deal, but they don't have as much of the sort of holiday vibe. But Sydney clearance rates, not too bad, really, still above 70%, given another very, very big weekend for auction numbers. These are still tracking around about the highest levels for the past year. No surprise, big fall in Melbourne auction numbers because of the Cup. And you can see there, massive fall of nearly 1,000 fewer auctions conducted in Melbourne last Saturday. But the clearance rate actually held up, Graeme, which wasn't too bad given those distractions. But the Melbourne market has moved a little bit sideways over the last month or two as we'll look at the trends. Brisbane up a little bit, but Brisbane with fewer listings, again, the
never an auction market.
And look, a reasonable result there. And we're seeing that Brisbane is still continuing to be quite a vibrant housing market. Both the rental and the house price market are moving ahead in Brisbane and most of southeast Queensland, continuing. Another 80% result in Adelaide, same old, very strong market. And Canberra bounced back to over 50%. But Canberra has been the underperformer over the last couple of months, Graeme. Some local factors there in Canberra are keeping housing market activity reasonably subdued, which is interesting. So this is the trend, down a little bit on previous results in Sydney, but still holding above 70%. And, of course, this November result just covers last weekend. Melbourne's similar to Sydney, holding at a reasonable level, but certainly not as strong as late autumn and early spring. Brisbane, again, holding at around about those levels. But, again, as we say, disclaimers for the Brisbane auction market, it doesn't have a strong culture. And just because we're getting lower clearance rates doesn't mean the market's still not quite vibrant, which it is. Adelaide, same old 80% clearance rates, very strong clearance rate environment in Adelaide. And Canberra, as we've said, last few months, the Canberra market has really become a little bit more subdued. Some local factors at play there. you want to get those auction clearance rates every Saturday night on my LinkedIn account, you get the capital city headline results, which we saw at the beginning of these slides, of the auction slides. And every Sunday, we get the full, on my LinkedIn channel, we get the full national auction result, which includes regional breakdowns for Sydney and Melbourne. So get a hold of that one. And before we finish off, Graeme, here's our show bag giveaway that we always promote here on our weekly podcast. How much is my home currently worth? Well, here's a good forward indicator to help you with answering that question. And that's the My Housing Market Infinity House Price app. If you take a picture of that QR code, you can get a link to the app. Of course, there is a password. We must say that. And you can only get that password through Infinity, and that's held quite closely. But you want to get hold of the app. It's a great little app. It gives you the asking prices for every suburb and asking rents for every suburb in Australia that has an asking price and an asking rent. You can also filter that for property type. So you can filter it for house, for unit, townhouse. You can also filter it, Graeme, for the number of bedrooms. So you can find out a 1-bedroom townhouse or 2-bedroom unit or a 5-bedroom house in your suburb or in the suburb you're interested in. And the data it gives you is quite comprehensive. So you get the high price, the median price, and the low price for all those filtered objects. We've got a screenshot here using Blacktown in Sydney as an example. And you also get the number of listings. So you get that not only for asking prices, but also asking rent. So a good one for landlord. We're going to produce an updated app soon, which will also give you the yields. Good news for investors. Nice. They're looking for the best yields. And also give you the capital city yields as well. Sorry, the LGA yields for the particular LGA in that suburb.
Excellent.
So more comprehensive insights. And an upgraded app will also, Graeme, give us a look at the top performing suburbs for yields in our capital city markets. So look forward to that one. But certainly this one in its current state is a very handy little app to have on your phone.
Very amazing resource, Doc. Thank you.
So we can do that. Next week, as we've mentioned, house building costs. We'll have a look at September home loans. The ABS are now starting to produce first home buyer data again after a pause of a few months.
It's back.
So we can have a look at that. And just for something different, which we haven't done before, Graeme, we're going to look at My Housing Market also produces a property value index. So what we do is we divide each capital city into the prestige market, the mid-price market, and the budget market. So we can tell which price sector is doing the best in each capital city, and we can compare that capital city to capital city. So we're going to have a look at that index next week. Are prestige property doing better than budget property in which capital city, or are budget properties doing better than prestige
Very
property?
Interesting.
How's the mid price market going? So I'll have a quick look at that last week, as well as the latest weekend auction results. Second week in November, we are getting to the back end of the spring selling season. We're only going to have 4 weekends left after that of auction activity. And as I said, typically we do see lower clearance rates, but it's been a very strong auction year, unequivocally strong auction year, particularly in Sydney and to a lesser degree Melbourne, and of course very strong as usual in Adelaide. But most markets, as we've seen, are going to record double-figure price growth. And we know that looking at the auction market, that's been a very good forward indicator of those outcomes, Graeme. So look forward to next week with more information, and we can maybe give the RBA a little bit of a rest when we discuss what's happening.
We'll give them a rest until their next increase in December, maybe. So there you go. Amazing as always, Doc. Thank you. And ladies and gentlemen, make sure you're checking out Dr. Wilson's LinkedIn for live up-to-date data. And for those of you in our community, make sure you're in the private group to get the password to access that amazing resource that Doc has provided to our community. We'll see you all next week. Thank you, Doc, as always.
Thank you, Graeme. See you later.
Thanks, Doc.